Hello everyone, and welcome to this comprehensive guide on mastering market volatility. I'm Alex, and today we're diving deep into a powerful tool, Bollinger Bands. These bands are essential for understanding market volatility and making informed trading decisions. Whether you're a beginner or an experienced trader, this guide will enhance your analytical skills. We'll cover everything from the basics to advanced strategies for risk management. So, what exactly are Bollinger Bands? Let's break down their core components. At its heart, a Bollinger Band consists of three distinct lines on a price chart. The middle band is typically a 20-period simple moving average, indicating the average price. Then we have the upper and lower bands, which are derived from standard deviations. These bands expand and contract based on market volatility, acting like dynamic envelopes. The distance between the bands directly reflects how volatile the market currently is. Wider bands suggest higher volatility, while narrower bands indicate lower volatility. Understanding this dynamic expansion and contraction is key to interpreting market sentiment. Now, let's explore how to interpret these bands to identify potential trading opportunities. A common interpretation is that when price approaches the upper band, the asset may be overbought. Conversely, when price nears the lower band, it often suggests the asset is oversold. These are not definitive signals, but rather indications of potential reversals or corrections. Another key pattern is the Bollinger Squeeze, where bands narrow significantly. This squeeze often precedes a period of increased volatility, a potential breakout. Traders look for these squeezes as a sign that a significant price move is imminent. Conversely, when bands are wide, it suggests a trend is already in motion. Price tends to walk the band during strong trends, staying near one of the outer bands. This band walk can be a powerful signal for trend continuation. Now, let's move on to how traders use these movements to plan their entries and exits. For entries, traders often look for price bouncing off the lower band in an up. This suggests a temporary dip before the trend continues, offering a good entry point. Conversely, a bounce off the upper band in a downtrend could signal a short entry. For exits, reaching the opposite band can be a strong profit-taking signal. If you entered a long position of the lower band, consider exiting as price hits the upper. This strategy aims to capture the move between the bands, capitalizing on mean reversion. Another exit strategy involves using the middle band as a dynamic support or resistance. A break of the middle band can signal a shift in momentum, prompting an exit. Remember, these are guidelines. Always adapt to current market conditions. Effective risk management is paramount in trading, and Bollinger Bands can assist here. One powerful application is using the bands to set strategic stop-loss levels. If you're long, placing your stop-loss just below the lower band can protect capital. This allows for normal market fluctuations while limiting downside risk. Similarly, for a short position, a stop-loss just above the upper band is effective. The dynamic nature of the bands means your stop-loss can also be dynamic. As the bands move, you can adjust your stop-loss to lock in profits or reduce risk. This adaptive approach to stop-loss placement is a significant advantage of using Bollinger Bands. Always define your risk tolerance before entering any trade. While powerful alone, Bollinger Bands are even stronger when combined with other indicators. Integrating them with momentum indicators, like the Relative Strength Index, RSI can provide confirmation. For example, if price hits the upper band and RSI shows overbought conditions, it's a stronger signal. Similarly, combining with volume indicators can validate breakouts from a Bollinger Squeeze. A high-volume breakout adds conviction to the move, reducing false signals. Moving averages, convergence, divergence, or MACD, is another excellent complement. MACD crossovers can confirm trend changes indicated by Bollinger Band movements. The goal is to build a robust trading strategy by seeking confluence of signals. Always backtest your combined strategies to ensure their effectiveness. In summary, Bollinger Bands are incredibly versatile for market analysis. They help identify volatility, potential overbought or oversold conditions, and trend strength. We've learned how to use them for planning precise entry and exit points, and crucially, how to implement dynamic risk management strategies with. Remember, practice and continuous learning are vital for trading success. Experiment with different settings and combine them with other tools. If you found this guide helpful, please like this video and subscribe for more content. Visit our website for additional resources and in-depth trading courses. Thank you for watching, and happy trading.